Thank you for joining us for Analytics in Action, using IDEA to detect fraud. Today we will be hearing from Jeremy Clopton, a director in BKD's Forensics and Valuation Services Division. He leads the Big Data and Analytics and Digital Forensics practices. As a specialist in using data analytics for fraud prevention and detection, we invited him to share his best practices in these areas and to show us how you should be thinking proactively when it comes to preventing losses. We will be recording the session. The session slides are available as a handout. You should see that on the GoToWebinar screen. And we will send the recording out later this week. If you have any questions, please type them in the questions box on the right side of your screen. We'll try to get to those throughout, and also if we have any at the end, we'll cover them at that time as well. I'm going to go ahead and turn control over to Jeremy. Welcome, and Jeremy, thanks for joining us.
Thanks, Lindsay. I appreciate it. Glad to be here, and good afternoon or good morning, everyone. Glad you're joining me today, and really appreciate the opportunity to speak with you today about using IDEA to detect fraud. This is a topic that is near and dear to my heart, one that I'm very passionate about. As Lindsay mentioned, I am a director at BKD, and I lead our big data and analytics and digital forensics practices, and have spent the majority of my career as a fraud examiner, and the vast majority of it really focused on the use of analytics for that. So really looking forward to talking to you today about this topic. We're going to talk about why we even have a need to discuss using IDEA to detect fraud, why that's even a problem, what it means for the organizations. We're going to talk about a framework as to how you can actually get started applying IDEA to detect fraud, because I find that that's one of the biggest challenges for almost every organization is where exactly do I start and how exactly do I start? Now, I can't necessarily answer the question where to start, though I do hope to be able to provide you some guidance that will help you along the way. And then finally, we'll also talk about some case studies, just show some examples and talk about how IDEA could have been used to detect fraud in cases where it very likely wasn't, and what that can mean. As a quick story, I had an investigation about 3.5 years ago, and it was a $1.2 million fraud investigation, and it was in an organization where $1.2 million was actually pretty small dollars, but the president was still quite upset about the loss. And what I found interesting is that the organization said they really didn't have a tool that would have allowed them to find this fraud. And I sat there and thought to myself, this is just absolutely crazy to me, because there's quite a few options out there, and if you were to take a tool like IDEA, that is a pretty easy to use tool, they could have found this fraud in about 5 minutes. Every single check written on a weekend for a 3-year period was fraudulent. Every check on a holiday was fraudulent, and those are tests that are so simple to perform in a tool like IDEA that they could have found that in 5 minutes and stopped at maybe $50,000 in, instead of waiting until it got to $1.2 million, which is a bit more problematic. So we're going to talk a little bit that as we go along. As Lindsay mentioned, I would welcome you to please, if you have questions, ask them throughout the session. I'll do everything I can to either work the answer into what I'm talking about or answer them at the end. I want to make sure that you all get everything that you're hoping for out of this webinar, and that your questions, if you have them, are answered as we go throughout the day today. So why is this even important that we're talking about using IDEA to detect fraud? Well, if you look back a couple years ago, it was in August of 2015, there was a study published just before the American Accounting Association conference, which is an academia conference, talking about how success in corporate accounting is linked to a willingness to manipulate earnings. And as an accountant and as a fraud examiner, that causes me a bit of concern. When you perform studies and you ask executives and recruiters which candidate are you more likely to hire, and they tend to lean toward the one that's willing to manipulate earnings and do what they can to make a profit versus have the higher moral ground and is willing to be a rule follower, so to speak. That really indicates to us that we have a bit of a problem, really, where we don't have success being tied to performance, but rather it's all tied to a willingness to manipulate. We know that we've got a problem, and that means that we have to come up with a solution to help solve this problem. Now, I'd love to tell you, working for an accounting firm, that an external audit is going to do that. In fact, if you look at the Association of Certified Fraud Examiners report to the nations, The number one cited anti-fraud control in that study was an external audit of the financial statements. The problem, and all the CPAs that are attending hopefully understand this quite well, the problem with that is that an external audit isn't even designed to find fraud. It's designed to determine are the financial statements presented in a materially correct fashion, not to find fraud. So we have most organizations relying on a control that isn't even designed to be an anti-fraud control. And other than that, I mean, data analytics, for that matter, is one of the least commonly cited. I think it was about a third of organizations were using it. So if we think about that, most organizations aren't looking to analyze all of their data. Rather, they're relying on an approach that's largely sampling based. Well, let's look at how effective sampling is, and we all probably know how effective sampling is. But even large samples really don't get us what we're looking for when it comes to a fraud. The $1.2 million fraud that I mentioned just a bit ago, that represented less than 0.1% of all this organization's transactions during the year. If you would have tried to find that, the odds are very much stacked against you. But just to drive it home a little bit more, let's think about this. There's a picture on your screen right now. It's covered up with a bunch of boxes, and I'm going to pull a 10% sample of that picture. And I would argue that most auditors, whether internal, external, or otherwise, or anybody that's pulling a sample of data, if you pull a 10% sample, that's probably the biggest sample you've ever pulled. But still yet with 10%, there are probably quite a few of you that have an idea as to what the picture is, but most of you probably not. Well, if we up it to a 20% sample, now you can see that we have a much clearer picture as to what this image is that's on your screen. We have a much better idea, and most of you have probably already recognized what you think this image is. And if you think about it, you can probably even say exactly what it is and describe it. And many of you are probably saying, well, it's a Rubik's Cube. It's cube. It's got a lot of colors on it and multiple sides. But it's not until we actually fully look at the entirety of the picture that we realize we really don't know what this looks like until we look at everything. Even with a 20% sample, which is a pretty good sample size, we're not going to be able to see exactly what it looks like. And that's really true when it comes to finding fraud in your data sets. You can't take the approach of we're going to pull a sample of 30 or 50 or 100 and review it. You really need to be using analytics. You need to be going in and performing 100% analysis of your data set so that you can see really what's going on within the data. So you can see the patterns, the trends, the exceptions, and focus in on the problems. And it's tools like IDEA that help us to do that. So we know that there's been studies on this, but what do the statistics tell us? I do like statistics, though they can be slightly manipulated. But what are the costs of fraud? And if we look again at the ACFE's report to the nations, we can see that the average organization loses about 5% of its annual revenue to fraud. And this number really hasn't changed much, really over the entirety of my career. Over the past decade plus, there really hasn't been a big change in this number. One year it went up to 7%, but it stayed pretty steady around 5%. But what's a little bit more concerning is if we look at the big frauds that are out there, what we see is that almost a quarter of the frauds in this study now are losses of at least $1 million. And a loss of $1 million is a pretty big fraud. I don't care what size of organization you're in. I don't think you're going to find anybody that owns a company or owns an organization or is the founder or leader or president that's going to say, oh, it's just $1 million, don't worry about it. Even the largest organizations in the nation or in the world would probably be upset if somebody stole $1 million. And that number is growing. What's even more concerning, though, is if you look at how the number of people involved impacts the median loss of fraud due to fraud, you can see that frauds perpetrated by one individual, they're pretty small, they're easier to find, quicker to detect, the losses stay pretty small. But when you get multiple people involved, especially if you get 4 or 5 or more, those frauds, those losses jump really quickly. I mean, if you have 5 or more people involved, you're up over $600,000 as a median number. You've got collusion, you've got concealment. It's not going to be sitting there labeled as fraud expense in the data. It's going to take some digging. It's going to take some analysis. It's going to be taking and looking for those patterns that have changed over time that really indicate to us that there's an anomaly in our data. Now, as I mentioned, those that have anti-fraud controls tend to do better than those that don't. And if you look at it, the single most effective anti-fraud control out there, according to the study, or that was studied, I should say, there are probably more fraud controls out there that aren't involved, but the most effective anti-fraud control was proactive data monitoring or analysis, which I'm going to collectively refer to as data analytics. You can see that from a median loss, it's more than a 50% reduction. From a median duration, it was also a 50% reduction. Data analytics is a very effective form of anti-fraud controls, and it's because we're looking at the entirety of the data set. We're looking for those trends, those patterns, those exceptions. We're really focusing on our efforts on the transactions that are concerning rather than just a set of transactions in general and hoping that one or more of them might be concerning. Now, if we look at the frequency of schemes by industry, and I think that we have a pretty good representation of industries, if I recall from talking with Lindsay on this webinar. What's interesting is if you look across the middle of this graph, this chart, what you're going to see is an orange to red line going across the middle horizontally, which indicates that corruption is really the #1 fraud scheme across virtually every industry with the exception of professional services. Even religious, charities, and social services, it's up there at the top as the most common fraud scheme. Right after that, you'll notice that the orange and the red typically falls around billing and expense reimbursements. All of these are areas where funds are going out the door. Corruption typically involves power. It involves somebody who has influence, the ability to conceal. And all of this is going to be found somewhere in our data set, generally speaking. Accounts payable, purchasing cards, payroll. You may have to get a little bit more creative and go beyond the financials and look at the email systems and other unstructured data. But a tool that's focused on analytics can help to do this, and that's really what we need to focus in on here is how can we do that. Now, one of the first questions that I get when I talk about analytics for fraud detection is what about big data? Because everybody wants to talk about big data. You know, it's the buzzword right now. It's probably to the point where most of you are probably tired of hearing about it. And really, the question ends up being, is big data, is that the solution to everything out there? Or some will even say big data is really the problem, isn't it? It's the fact that we have big data that we can't figure out how to use it. And what's interesting is big data is defined so many different ways that you'll find that organizations debate it over and over and over again. What is big data? Do we have big data? Is our technology big data? Is our data big data? We really don't know. But what's interesting to consider is that the data itself is completely neutral. It really doesn't matter if it's big data, small data, or medium data. You have data. The data is the data. It's neutral. It's the people that are using it that have the agenda, which really means how you decide to use the data determines whether or not it's going to be a problem or a solution. If you feel overwhelmed and you can't do anything with it, big data becomes a problem. If you look at it and say, great, we've got great insights, we've got the ability to analyze this, all of a sudden now big data seems to become the solution. But you have to remember that the data itself is neutral. The data did not commit fraud. The data will not find the fraud. It's how you use the data that's going to help you do this. Now, one thing that we can agree on across the board, the volume of data is increasing in each and every organization. Everybody on this call, that's applicable to. You know that you have more data now than you've ever had before, and probably less data today than you're going to have tomorrow. So that isn't really one of our debatable topics. But what we do have a problem with, and what I'll say the problem really is we're not focused on the right things. A lot of organizations are still focused on the debate over big data. Do we have it? Do we need it? Do we have the technology? Do we need a Hadoop cluster or not? That's a problem. If that's all we're going to focus in on is debating what is big data, that's a problem. What we need to be focused in on is how can we use a tool that we may have, such as IDEA, to help us get the insight and value out of our data so that we can solve the problem of fraud within our organization. We need to be focused on the use of the data, not the size of the data, not the technology necessarily, but how can we use our data with what we have to solve our problems? Now, there are some challenges here. If you consider it, a lot of us see data each and every single day. And this is an example from Twitter, obviously. What we typically see is the data. You might see it in the financial statements. You've got a debit, a credit, a date, an amount. That's the data. But really, if we start to look back behind just what we see in our everyday reports and our everyday use, there's an enormous amount of data behind the scenes. And this is actually the same tweet as I just showed you, but in data form. There's an enormous amount of data that's out there. And while this may look very daunting, and you may think, well, I can't use that type of data, I don't have the right tools for it, this can be analyzed in a tool such as IDEA or any tool that allows you to use structured data, because this is text. You can put text in there just the same as you can put a vendor name in or a journal entry description in, and you can analyze it. There's additional information in there that can be pulled out using a data analytics solution that allows you to break it down into columns and rows, which frankly, as an accountant, I absolutely love. We all love columns and rows and anything that fits in something that looks like Excel. It's our accountant's nature. And the solution that helps us get over all of this challenge really is analytics. It's the processes that we're using to help get useful information out of our data, no matter how hairy it may look, to answer our strategic questions. But that's not the only challenge and solution that we're going to need to have. There's another challenge that's out there, and that challenge is, how do we get away from focusing in on the individual details? I just mentioned that $1.2 million fraud. It was less than 300 transactions, 296 checks to be exact. How do I get away from trying to look at 296 items, hoping that I find the right 296, mind you, drawing individual conclusions about each and every individual item, and actually step back from that and say, what does the data tell me? What are the patterns in the data? There were some patterns in this data set that would have been blatantly obvious had they been examined. What are the patterns, and how do we find those patterns? And the solution to finding those patterns is data visualization. And this is a screenshot of the Discover feature in IDEA that allows you to see insights, see visually your data in a way that you haven't necessarily looked at it before. How can you use that to help guide what you're doing? You can see in the upper left-hand example, for instance, you don't have to know what this screenshot is even showing, but you can see 2 red bars and the rest are all blue. We probably know where we need to focus. Red is bad. Let's focus on those bars. And very quickly, using visualization, we've seen the patterns and the trends that help us focus in our efforts on exceptions so that we can evaluate those specific transactions. Now, the reason that we want to do all this is so we can get the right information to the right people at the right time so that the right decision gets made, which means better mitigating our fraud risks. We all have the risk. We have to do a better job of mitigating those risks. How do we do this? Well, first, we have to start thinking creatively. And I realize as an accountant, saying be creative, that sounds like the most ridiculous thing for me to say. But I'm not encouraging creative accounting. I'm encouraging you to be creative in how you look for accounting. So you have to be creative. You have to think about how a fraud may be occurred and perpetrated within your organization, and then what might that look like in the data? How would you see that? And to do that, to be successful, you've got to change your mindset. We can't keep thinking, let's wait and set up a red flag system once a fraud occurs so we know to go in and look for it. We have to start thinking proactively. How can we start looking for fraud risks before we see that a transaction occurred that looks like fraud? How can we get out ahead of it? One way that we can do that is to focus more globally on the fraud triangle. Historically, we always focus our efforts and our analytics on the inside of this triangle. It's a red flag system that says that fraud has likely occurred. What I would encourage you to do is see if there are other ways that you can address the fraud triangle using analytics. How can you find pressure in your organization? Do you have text that you can analyze to identify communications that may indicate pressures? Can you identify rationalization, people saying that they're overworked or underpaid? Keep in mind, at the end of the day, email and instant messages, they're text. It's still data, and it can still be analyzed using an analytics solution. Probably the one that's easiest to approach that a lot of organizations overlook is opportunity. Every accounting system has behind it a set of tables that has the user IDs and all of their permissions. Let's get that table of data and let's see who has the opportunity in our organization to commit fraud. That way we know where we need to focus our monitoring efforts a bit better. We have the data, we just have to start using it. So how do we start using it, right? That's the next natural question. So what I would like to do is give you a guide. How can you achieve your strategic objectives around fraud risk mitigation? Now, I can't tell you where you should start looking for fraud in your organization. As I showed earlier, the most commonly it's corruption, expense reimbursement, and billing, but you have likely done a risk assessment in your organization. That's probably where you want to start. And you start by asking a strategic question. Where in our organization does corruption exist? Do we have corruption in the RFP process? Do we have fictitious vendors in our accounts payable system? Do we have fraud, waste, or abuse in our purchasing or corporate credit cards? I will tell you, if you can't figure out and you can't decide where to start, even after looking at the goals that you have in your organization for your risk assessment and what you want to focus in on, if you're still struggling with a place to start, I would encourage you, look at your corporate credit cards if you have them. Get the level 3 detail that comes from the bank. That's going to be a gold mine to start with, and it's typically a fairly inefficient review process. That is a great place to start with analytics as it relates to fraud risk. But outside of that, what I would encourage you to do is go back to your risk assessment. What are the items that you have on there as your goals for the coming year to focus in on, to address, to monitor the risks, to mitigate the risks, to test for those risks? Go in and focus on those areas when you start to apply analytics, because that is going to make the most difference in your organization. It needs to become part of what you're doing, not just another step in addition to everything that you're already doing. Once you have your question and you know what area you're going to focus in on, the next thing that you need to do is define your objectives. The more specific your strategic question is in step 1, likely the fewer objectives that you're going to have. Whereas if you ask a pretty broad question, where is fraud in our organization, you're going to have a very long list of objectives. So I would encourage you to consider the objectives in light of your strategic question. What are the specific things that you need to accomplish to answer that question? What this is going to do is it's really going to give you your game plan for moving forward. If you simply say, we're going to apply analytics tomorrow, ready, set, go, I can almost assure you that is not going to be as successful as you're hoping it will be. I've had organizations that have reached out to me and said, hey, we've got an analytics program up and going. We're ready to start automating our procedures. What do we do next? And my answer is stop trying to automate it and first figure out what exactly you're looking to do. Because if you don't have a plan how you're going to address fraud risk within accounts payable, say we're going to look for weekend checks, holiday checks, round thousand checks, checks made payable to cash, hold for pickup, do not mail. Without those objectives, without that plan, it's very difficult to know when you've even come close to answering that question or accomplished your goals. So you want to make sure that you have objectives and you have a clear plan. From that, the third step is to obtain the data. And I realize you're going to have to work with IT, and for some of you that may be frustrating or something that causes an additional challenge. And some of you may be thinking, I'm in IT and I know people are going to reach out to me, and that frustrates me just the same. What I would encourage you to do is develop a working relationship with IT as soon as possible when it comes to the application of analytics. The more that you can have that working relationship, especially when it comes to fraud risk, the easier it's going to be to get access to data when you need it. Now, ideally, you're going to have access maybe through an ODBC connection or a direct connection where it's read-only access to your ERP system. or maybe you have IT that has scheduled data pushes for you on a routine basis. But either way, you need to get the data that you're going to use both for your analysis and your follow-up. And the one thing that I would encourage you to do, even if we're still talking about basic analytics and structured analytics, I would encourage you to go beyond the traditional systems. Don't just stop with the accounting system. What other data sets do you have out there that could indicate risk? Do you have building access logs so you can see who came in on the weekend, who was on their computer posting entries over the weekend, who had access to check stock, when did they log into that, when did they use their badge to swipe into that room, who's been logging in remotely from a new workstation or through a VPN that they've never used before, or a brand new IP address. What other data exists out there in your organization that you can use to help mitigate your fraud risk? I would encourage you to think beyond the accounting system and get that additional data as well. Step 4 is developing and applying your procedures. Now, ideally, these procedures are going to be designed to help you meet your objectives and answer your overall strategic questions, because right at the end of the day, that's what we're looking to do. What I would encourage you to do when you develop and apply your procedures is to really think simplicity first. And the reason that I encourage you to do this is because you don't have to have the most complicated procedure for it to be successful. I mean, very likely you're going to be using the results of this analysis to work with somebody else in the organization. The more data that you give them, the more confused they're going to be. If you only give them a very, very minuscule amount of data, they're probably still going to be confused. You want to get just the right amount of information, and typically that means simplistic procedures to start with. Now, if you're on this webinar and you're saying, Jeremy, that's great, we already do this, we already have some pretty standard procedures, how do we go to the next level? What I would encourage you to do is start to think about how you can implement those on a routine basis, monthly, weekly, daily perhaps, depending on your frequency of activity. How can you automate those so that you're actually evaluating things on a more continuous basis and you're having that fraud risk mitigation and closer to the speed of business? I think that would be very beneficial for you to do. At the same time, I would highly encourage you to leverage the tool that you're using. And we're talking specifically about IDEA here. There are a number of tools and tests already built into the IDEA software that are so beneficial. Being able to join between a vendor file and an employee file, or using Visual Connector to find all the matches on a Social Security number perhaps. Looking for the day of the week, the round thousands, being able to run the Benford's Law analysis and identify any anomalous activity that way and drill into it. I would encourage you to view and really review all the tests that are already built into the software and see how can you leverage those for some of your straightforward procedures as well as then your next level procedures. The other thing that I would encourage you to do is leverage as much technology as possible. There are a number of tools out there that are very good at helping you beyond just IDEA. What can you use that can allow you to integrate some of your results with IDEA? If you think about it, some of the machine learning platforms that are out there now, the languages such as Python and R, while you may not be able to program directly within IDEA, you can still run some analytics or run some commands and procedures that are using Python or R, and then import the results of that directly into IDEA for additional analysis, to where you can really leverage multiple technologies to still accomplish your goals. I think that would be, you definitely want to do that when you're looking at fraud risk, because they're changing all the time, and you want to make sure that you are picking up on all of those items. Step 5 is figuring out what the results tell you. And this is something you've probably already done regardless as to whether or not you're using analytics. But you really have to analyze your results and figure out, have I met my objectives and have I answered my strategic question? At the end of the day, if you haven't, you need more procedures or you need better procedures. And you probably have some false positives that you're going to have to deal with the first time around anyway. If you don't have any false positives, I would argue that you probably have missed something and that you designed the analytic too narrow to start with. I realize that sounds somewhat contradictory, as we're talking typically with analytics about efficiency, but really we should focus on effectiveness first, and sometimes that means some false positives to start to make sure that we're picking up on everything that we want to pick up on. So I would encourage you to analyze your results. What do they tell you? Do they meet your objectives? Do they answer your question? Or do they tell you that you need to go back and design a better analytic? Keep in mind, you're probably not going to design the best, most perfect analytic the first time out. Just because it doesn't meet your objectives or it doesn't answer the question doesn't mean that that analytic was a complete failure. In fact, it may give you other insights that are very beneficial. Really, that should be viewed as a way to learn and develop something even better the next time around. I would argue that you can probably learn something about your data, your organization, behaviors from every single analytic, regardless as to what whether it meets its ultimate goal or its initial goal. There is something to be learned from those analytics, and I think it's important to do so. Step 6 is managing the results. So how do we get the results and put them to use? When it comes to fraud risk mitigation and fraud detection, you've got to get your team involved, whether that's the team in internal audit, in finance, in accounting, executive management, or all managers across the organization. When it comes to fraud risk management, it is not a one-person job. It is an organization-wide task, and it really needs to be that way. So when you try to get the results of this, the results of your analytics for fraud detection and risk mitigation out into the business processes, you've really got to work in a very collaborative way to accomplish that successfully, because you can't go out there and police every single section, every single process within the business. You're going to need to get that buy-in. You're going to need to see what are the insights and how can you implement that to help you do that. You're going to know you're successful in doing this when analytics is part of your culture of risk assessment and risk mitigation. It's not viewed as, oh yeah, we have to go do analytics now. We've already done all of our risk assessment, all of our fraud testing. Now we have to go out and do analytics. That's not viewed that way at all. You really need to get out there, and it needs to become part of what you're doing and part of the consistent thought process. So what are some examples? What are some of the examples of actually using this in practice? So let's go ahead and show a quick example here. What we have is we have a network here, and this is built out. This is a loan officer, some folks that they have lent to, so some of their customers, as well as a network of some of the owners and other relationships. All of this can be done in IDEA. And really what we did is we took the loan files, we took the customer master file, and we took some extraneous information that we had as well and loaded that in with a file through as its own Excel file, and just loaded it in, into IDEA. And what we can do is, in using the join commands and the visual connector commands, we have the ability to then go in and actually build out this network. How are individuals related to one another? How are they related to the owners? How are they related to the lender? How are they related to the properties and the companies that are in here? And we can see that Tom is a lender to 2 different communities or 2 different networks that share an appraiser, and they also share a partnership. And at the end of the day, they also share a common property in which they have ownership. That relationship becomes very important because Tom is really the hub here, and then that is the only other connection between these 2 communities. And what we found in this situation is this is not actually what it was purported to be. There were progress pictures, and this had really been developed out, this property that had been invested in, when at the end of the day, this is actually what the property looked like. And it was through the use of these the network building and using analytics to identify and join the various files and the various attributes together to build out that network to identify the anomalous relationships. This is actually a picture of this development that actually had pictures of being completed. This is in reality what it looked like. As it turned out, the pictures that were used in the loan files were stock photography found through a Google search as well. Collusion and embezzlement is another one. In this case, we can see from email analytics, we can see They were expecting 9 zebras. Can you please transfer the entire amount to U.S. bank account once it's received? And you can see it then says zebras were received today, and then you can trace that into the bank statement as well. And this is an example as to where you can pull data from email, and email data can be converted to a text file that can be used in IDEA, and looking for anomalous patterns, unusual words, unusual topics. Lindsay, if I remember correctly, I think somebody there at Automation has actually built out a process that does the word parsing and actually counts out the words to identify unusual frequencies and unusual terms that are used in text. So you can use that in conjunction with analyzing bank activity to identify, potential collusion or potential problematic activity. Another example is fictitious vendors. In this situation, there was an employee that had set up a vendor at a UPS store, traditional mailbox service, and it was one very close to the location of their house. Some uses of IDEA that I would encourage you here, looking for those addresses that appear to be that of a mailbox service. Anytime you see personal mailbox or the letters PMB within an address field, a lot of times that indicates that it may be a mailbox service such as a mailboxes, etc., UPS store, FedEx, Kinko's, what have you. The other thing that you can do is you can use sites that provide geolocation data, the latitude and longitude of addresses, and then calculate the distance between those points using some of the functions and commands within IDEA to determine, do we have, in this case, a vendor or a business entity that is located in a residential area. We've seen this time and again in fictitious vendor schemes that somebody sets up a fake vendor in an area that should not have, say, a manufacturing company or an industrial plant. And you can get that using the latitude and longitude data there. Bid rigging and RFPs is another situation, and this is one where you're looking at trend analysis. And IDEA has a very good trend analysis and forecasting module within it. And here what we're doing is we're looking at the trends compared to the termination date of a purchasing director. It turned out this purchasing director was terminated for something else, but then after the fact we were looking at it to see, okay, what vendors were they involved with once we found out a scheme had been perpetrated where they were actually calling vendors and saying, okay, here's the low bid, you need to submit one lower. And we can see that if you look at the trend activity, you see that once it hits that termination date, that the activity really stops or goes to almost nothing. It changes significantly. And this is really a good use of trend analysis and comparing data sets from two different systems. This is accounts payable activity compared to payroll activity. So we want to look at that and see how those key events translate as it relates to particular trends and their analysis tools within IDEA for that. If we look at embezzlement, the city of Dixon, Illinois is probably one of the most classic, largest embezzlement in U.S. history. You can see there's the acceleration pattern of activity. Again, we talked about trend analysis and IDEA. This is a great application of that. Looking for this, the kind of a small growth at the start, but then a very quick growth from there, where somebody is testing the waters, seeing if a fraud can be committed, and then really ramping it up from that point. Looking for round $1,000 increments. You can see that this check was just shy of $2 million, or this invoice. The now due amount is $350,000. It sounds ridiculous a lot of times, but round 1,000 increments are fairly uncommon when it comes to invoices. It seems like nobody would, still be trying to commit fraud using them, but people do it each and every single day, so we want to make sure that we're looking for that. Here's a situation where you have stolen checks. And we can see that we have, addresses that have a care of and a hold for pickup. Those are addresses that can be identified using testing within IDEA to isolate those and look at the activity within them. You can see, again, round $1,000 increments, unusual increments, initials within or acronyms within the payees, common phrases or terms. Again, you can see Chappahome across the board here. So looking at the text, we have to make sure that we're not afraid to look at the text. Yes, the numbers are interesting, but let's not forget the text because it can be very valuable to us as well. Cash receipts testing and trending, again, another use of trend analysis, looking for changes and patterns over time. These are two different cashiers. You can see that one has a significantly lower amount of cash than the other. That was the cashier that happened to be stealing cash out of the cash register and replacing it with checks. So what we'd want to do is we'd want to look at these trends over time to identify the anomalies. Look at it for each individual cashier and see if there are unusual patterns that are out there. Conflicts of interest, again, and related parties. Using the join and visual connector commands with an idea is very helpful. Looking for commonalities on name, address, social security number, phone number, bank account, zip code to see if you have one employee and one vendor in that zip code. They're the only ones out there. Looking for those relationships can be very valuable and very effective and efficient with an idea to accomplish those tasks. Really, at the end of the day, what we're looking to do with analytics as it relates to fraud detection is to expand the detection horizon. We're trying to get out there and find these fraud risks sooner, not later. Because right now, a lot of what we're doing is waiting till that fraud occurs, which means that the fraud has hit the organization, and that's where we're looking for it. If we start to expand our traditional sources and our use of analytics, we can catch these frauds before they make a big impact on the organization. If we expand it even further to some of the unstructured data sources that we've talked about, looking at the security in your ERP system, looking at the emails, social media, other types of unstructured data, we can really expand our detection horizon and find that signal that's hidden out there amongst all the noise. I heard a great description of analytics is not actually looking for the needle in the haystack like everybody wants to think that it is, but instead really what it is it's trying to remove the 90% of the haystack that doesn't have any needles so that we can focus on the 10% that does. And I think that's probably one of the best descriptions of analytics and one of the best reasons that we need to be using analytics, especially when it comes to fraud detection, because there's plenty of needles out there. We know that fraud is occurring, we know the risk is there, so how do we focus in so that we can actually review just those items? Now, there are going to be challenges to overcome when you do this. Anytime you start looking at fraud risk within an organization, you're going to have policies and procedures within your organization as to what you can and can't do, what you can and can't use from a data standpoint. You have the ethical considerations. Just because somebody has pressure and opportunity doesn't mean that you can assume they'll actually rationalize and commit a fraud. We have to be willing to not jump to those conclusions. We have to use the data responsibly. We also need to make sure that we maintain proper focus. We have to be willing to look back, zoom out a little bit, look at the big picture. What are the patterns? What are the trends? Let's not get too focused on the individual transactions and trying to draw conclusions from a sample of 30 or a sample of 50, but let's look more globally and more broadly at the organization. What are those patterns and trends that are out there? And it's going to take a new mindset. I mean, we have to start thinking about how can we be proactive instead of reactive? How can we start looking at all of our business transactions and all of the data that's behind them in a comprehensive way that looks at 100% analysis rather than relying on a sample so that we can be much more effective in what we're doing. Now, let's not forget about efficiency, but let's focus first on effectiveness so that we can better mitigate our fraud risk and then focus on efficiency after that. So that's my challenge to you. How can you take what we've talked about today, the framework for applying analytics, how can you go in and ask that strategic question where you have fraud risk in your organization and start to change your mindset? Become more proactive. What are the data points? What are the tests that you can use to help get out ahead of that fraud risk and actually test 100% of your data, identify those exceptions, those unusual trends or patterns, and make an impact in mitigating the fraud risk within your organization? With that, I will leave my contact information on the screen for you. I'm happy to answer any questions that you have now. I know we've got one that's come in here. I will answer that here just momentarily. I'm happy to answer questions now, after the fact. Feel free to contact me. Always interested in talking more about how analytics can be used as it relates to fraud detection. So Lindsay, it looks like we have one question here. How do we differentiate from continuous auditing from when it then becomes a monitoring function of management. And I think that is it's a very good question to be asking, because really at the end of the day, a lot of the procedures from a continuous audit standpoint can also be used from a continuous monitoring standpoint. And I think the gentleman that asked the question here has already identified, when is it owned by management? And I think that's really the differentiator that's going to really determine, is it continuous audit or is it continuous monitoring? And I think that the organization has to make that transition. If you are actually testing as part of your internal audit plan on a daily basis, that can still be considered audit. I think once you have addressed the risk, you've made the recommendations, management has made the changes to go in and actually maybe modify a control or address that risk. At that point, in my mind, that's typically when it becomes more of a monitoring function of management. You don't want to not perform that analytic anymore. You still want that analytic to be performed, but you want management to be performing it, to continue to monitor to make sure that everything is working as designed. I think that's the point at which it transitions.
Thank you, Jeremy.
You're welcome.
We have one request to show the software, and I'll just, I don't know if we have time to really get that launched, so I'm not going to put you on the spot for that. But David, we do webcast frequently, and we can also reach out to you and show it to you personally. And then on the automation.com website, you can, there's a number of videos that show how people can get into the software and sort of get a kind of deep dive into how IDEA looks and feels. If we have any other questions, go ahead and pop those in. Again, thank you, Jeremy, for sharing with us. It's always great to hear your insights. And we will be sending out this recording, and I think that's it. I don't know if we have any other questions coming in.
Doesn't look like it, but if anybody has any after the fact, feel free to reach out. I'd be happy to talk with you. And Lindsay, thank you for having me, and everyone on the webinar, thanks for attending.
All right, thank you so much.
Have a good day.
All right, bye. Have a good afternoon.
You too.